all right, so here's your nest egg, and if you're this age, then this should be bonds, and then this should be stocks over here, right? And then as you age, then this is going to be bonds over here, and stocks get smaller. And so that's what these 2030, 2040, etc. funds actually end up doing. It's automatically switching from predominantly equity when you're young to predominantly bonds. So if mutual funds all on their own are actually bad, and I don't know that I would call it necessarily bad, but if that's where the problem is, what do we do when we know that vast majority of our money is inside these mutual funds? So for one of the things that you absolutely want to do is you want to look at the expense ratio, at the expense cost. And again, you will see it range anywhere from 2 to 3% on the average. Sometimes they're a little bit higher. Sometimes you'll get them at 0.5% to 1%. You want to go shopping for the lowest cost possible. Now, John Jack Bogle, I guess would be the correct way to say it. Vanguard is one of the first companies that came out with ETFs. And so let's talk about ETFs. ETF, as we have mentioned, is really just this basket of all these different things and holdings that kind of follow the index or follow a particular industry or market. And they're typically lower cost, but there's a problem with them as well. They are what is called a robo-trading. It's this passive trading where it's an algorithm that is trading on your behalf. So in mutual funds, oftentimes, not always, but oftentimes, you will have a human being who is trading on particular set of accounts. So they sit there and they're constantly watching the market, and they're making decisions based off of their knowledge and experience, and hopefully they have a lot of knowledge and experience to steer your money in the right direction. The ETFs and ETNs are a little bit different, that it's the algorithm that actually does all of that trading for you. The benefit of it is that you can get it for a much lower expense. So one of the VOO is a Vanguard's version of SPY. So that's the version that follows S&P 500. It's the ETF. And so the benefit of going with that one is that the cost to manage is 0.05%. So it's a half a, right? So it's like a 0.5% that is being charged. So you're paying less for the fees. But the problem with the robot trading that really has affected the market, and that's kind of what we're going back into, just so you have an understanding, is that when the market, the algorithm kind of has things hit inside of the code, that when the market hits certain things, it automatically starts selling. So that's where part of the problem comes in, and that's part of what we have seen in the markets, is that there has been a little bit of fear, a little bit of panic. Some industries and professionals started selling. A lot of the algorithms started selling, and then once one sells, there's not enough buyers. It just starts tumbling down, and that's kind of what causes the market to actually start going down. Typically when you're looking to sell, so say that you want to sell this marker, right? And if I wanted to sell it for 50 cents and you are saying, yes, I think that that's a good deal, you would buy it and no problem. But if I want to sell it for 50 cents and nobody is, and there's hundreds of us trying to sell the exact same marker for the exact same price, nobody's buying. So next person is going to say 49 cents, 48 cents, 47, 45, 30, 20. It's going to keep going down until some point somebody says, you know what, that's a good deal, I'm going to buy all of them. And that's kind of what ends up happening with the markets, with the stocks, and that's sort of what we have been seeing. Sometimes the news these days are also written by algorithms. So what ends up happening is that you have a news source algorithm that is watching what the trading algorithms are doing, and writes a story based off of it, based off of what he can find on the net. It spits it out onto it as a news breaking story. The other algorithms are actually reading that, so then they trade based off of that news. So, I think that President Trump has been fairly famous over the past few years of calling a lot of things fake news, and I think that that's some of that stuff that we're seeing. I'm not saying it's fake, that it's not real, but there is this sort of algorithm trading based off of what the algorithm is seeing, and that algorithm is seeing based off of what the algorithm trading is doing. So it's sort of like this chicken and the egg concept happening of like which one came first, and nobody really knows. So here we are right now, right? Market was close to 30,000. We are flirting with 20 to 22,000. So we are down substantially. Some stocks have lost, 20 to 30%. Some have lost even more. If you have been following what's happening with the oil, and we can argue the whole piece of like what happened, but you will see that the oil also has lost quite a bit of money. Now, you might be hearing all kinds of different things and wondering, like, is this the time to go in and jump, like buy the dip, don't buy the dip, wait, figure out what companies I want to own. Here's some of the news or latest updates that I was able to find. And interestingly enough, yesterday, so Friday, when the market went up, I went up on some of the channels that I typically try to follow to understand sort of what happened, what they have to say, what their thoughts and opinions are, because I have my own and I wanted to see what they had as well. It was dark. It was silence, radio silence as they call it. There was nothing out there that I could find. It was just sort of like the market went up. Okay, cool. And so it's almost like nobody has anything to say about it, but I think that there's a lot to be said. We have received the news also yesterday, and that's what's caused markets to kind of go up, that there's going to be additional funding and stimulus happening for the economy, for the market, for small businesses, to really help navigate some of these concepts that we don't even know exactly what's going on or what's happening. That's predominantly what caused it to go up, and there were some predictions and suspicions that that is going to happen. As a matter of fact, I actually have posted well before President Trump did that they are looking at doing some of these things like, tax cuts and additional liquidity and so on. And a lot of people that have been watching this stuff have made the same predictions. And it's not because we have a crystal ball. Well, maybe some people do, but I don't. Mine broke years ago. It's really about understanding how the economy works and what folks have done in the past in order to understand what they plan to do in the future. Where we are right now is we are facing with the demand problem, we're facing with the liquidity problem, and we're facing with a large debt problem. Debt on sovereign level, meaning a lot of governments are indebted, but also debt on the corporation component as well as personal. So all of us are collectively carrying a lot of debt. And when these stimulus packages come out, that's all debt. Nobody has this, the government doesn't have this like stash of cash that they're sitting on. They literally go out and print new money. And it's not even printing per se, because, you see these sort of images or videos of like printing press of like, those giant sheets of $100 bills. That's not exactly what's happening. Like, yeah, sometimes that happens, but vast majority of our money is digital already. And I know there's a lot of folks calling and talking about, are we going all digital? What's going to happen? And perhaps that is the case, with coronavirus being a big topic these days. There are a lot of reports that a lot of the virus is being carried on the paper bills. Some folks have called it, saying that's one of the things that they're going to use to get us all to go digital. But you don't have to get people to go all digital. Most of us are digital already. Vast majority of people carry money on their phone, right? Like through Apple Pay and that kind of stuff. Vast majority of people are paying with their credit card, or they can just put their phone onto the thing and it will pay it. So most of us are already functioning in the digital world. It's very, very rare that you can go out and find somebody who can give you, even $5 worth of cash. Most people don't have any cash on them whatsoever. If they have any money, it's inside some sort of bank or institution, and then they will use plastic, whether that is a credit card or a debit card, it's irrelevant, but they are swiping, and so all of that transaction stuff happening is digital money. Now, here's some of the things, and a lot of people are having a lot of questions of, how long are things going to be closed, and how long will this last, and when will it die off? And I don't have answers to any of that stuff. What I can do is share some of my experience of what I have seen and some of the considerations that I have inside my head as I'm thinking forward on kind of where we are and what might happen. Liquidity, as I have mentioned, is a very big problem, and so that's why you're seeing government and Fed has already cut the rates and didn't do anything. Then the government is now trying to create extra money in that has seemingly pushed the markets a little bit higher, but we don't know if that is going to be sustainable. It could, or it could be, as some people call it, a fake out, where it just slightly goes up, hoping that more people go in, and then it just boom, drops right underneath you. So be very careful if you are deciding to play that game. If liquidity does become a problem, what could potentially happen is what is called the bail-ins and the bailouts. The bailout is when the government is actually giving money to the banks, to the businesses, to giving them these basically loans. Sometimes it's really like zero interest loans for 3 months, 3 years, whatever. They do different programs all the time. Sometimes it's just literally like it's a gift. Like, here it is, boom, it's done. We're not quite at the gift yet, but we already have seen where it's going to be zero to low interest to zero interest loans for some of these things. That's a bailouts. Bail-in is when the banks will actually take the money that is depositors' money. It's not banks' money. It's our money, right? It's the money that we have put in, that our employers have put in into our checking, into our savings. And the new laws and the new rules have allowed the banks, because they're sort of holders of it, to be able to use it. We have seen this happen in Greece most recently. There might be other countries. If I'm missing, I apologize, but I'm using Greece because I know that that's what happened over there, where they froze everything and you could only withdraw so much money. I want to say that there have been countries down in Latin America that have experienced that multiple times, where you can just go in and the maximum you can withdraw any given day is going to be like $50 or maybe $100 or something like that. And sometimes it's per day, sometimes it's per week. So that's where one of my fears kind of comes in, that could be something that is happening. So if you have a lot of money in the bank, it might be a good idea to have some cash on you in person somewhere. Now I understand that that's a big risk because, right, like if you're carrying a lot of money on you and people know it and everybody starts doing it, then we all end up being easy victims of pickpocketing, break-ins, and that kind of stuff. And so, I'm not saying put the farm on it, but, start thinking differently of where else could you put the money that is not necessarily inside a banking account. Some people have decided to go and get the safety deposit boxes inside the banks. The problem is if the bank declares a holiday, and they call it a holiday, it's sort of like a fancy name for what they're doing, but they don't have a good name. It just literally means it's closed, like that's it. So they came up with the holiday as to sort of have a good spin on something that might not be so good. If and when that happens, you can't go into the bank, you can't go and pull the stuff out, even if it's in a safety deposit box, you don't have access to it. And I'm not saying that the bank itself is going to go in and take it, although history shows that they have done that in the past. But what I'm saying is that even if they don't do that, you don't have access to it, so you can't access it. So start thinking outside of the banking institutions, outside of the system. That is going to be one of the key components to really kind of think through and consider. When it comes to investments and that kind of stuff, we've already covered that vast majority of people are sort of in equities, and because of the whole like inverse relation of like price yield kind of happening, that bonds have been in the bond market bull, and bull meaning basically that it's going up. There have been a lot of folks who again are much more well versed in paper asset investing, or as I like to call it, speculation. that they are all talking about moving to bonds. I personally have moved all of my retirement funds into the bonds, and here is why. Bonds could drop, yes. Equities could drop, yes. They could both go up, yes. So anything is possible. But here is my sort of way of thinking. And that is this, that if I'm in equities and they're dropping, 35% already, or 25% with a little bit of slight bump that we had on Friday, and who knows what Monday is going to come, that even if bonds sort of drop a little bit, if the market as a whole drops, say 50%, but the bonds drop only 10%, I'm okay. Like, that difference between the drops is much better. I don't want to pull money out of the retirement because, as you can see, I don't qualify age-wise. And so if I was to pull my money out right now, not only would I have to pay taxes on all of the gains, so that's penalty number one, and those taxes are going to be at my current taxable bracket. So whatever your taxable bracket is, that's kind of what you're going to have to pay for these puppies. And plus there's a 20% penalty if you're not of age. So that's a very expensive proposition. I might as well just let the market take it down, because by the time I add my income tax plus the penalty, I've already lost a lot of money. So I don't recommend doing that stuff. Some people have resulted in borrowing money against it and pulling the cash out. The problem with that is that you have a certain time period under which you have to repay it. And if you don't, then it's seen as a withdrawal and not as a loan. And now you're going to be penalized again with the whole tax and the penalty component if you're not of age. So that part is sort of out. The other solution that you might have is to look at what is known as self-directed IRA. The self-directed IRA, you have to have a custodian, so you're going to need to find one. I recommend using internet and doing a thorough research of who makes the most sense. But the benefit of self-directed IRA is that it gives you, sometimes it's called the checkbook IRA, because it gives you an ability to literally write a check to start investing in a bit more diversified set of assets. You still have some limitations, but it's a bit more diversified than just mutual funds, maybe some ETFs and bonds, that you can actually start getting into some precious metals. They have to be IRA grade, so make sure you focus on that if that's what you're doing. And you can also do some real estate. Now, when it comes to real estate, you cannot purchase a permanent, a personal residence for that. It has to be actually an investment property, and all of the money that you're getting from that has to go directly into the custodian account. You can't touch it. There's a lot of rules and kind of penalties about it. So you want to be very smart and very careful when it comes to doing something like that, if that's the direction you decided to go. For me, as I said, I decided to go into bonds because A, I believe that they're going to be printing more money. If they're printing more money, that means there's going to be more debt. And while those yields are going to get lower, so meaning my return on the money that I lend to the government or the big corporations may not necessarily bring me as big of a return, the price is going to go up, and it's going to, I think that the bull market, as much as I think at some point it's going to stop, in a short-term period it is going to continue. And that's just my personal opinion. I cannot give you an advice legally of what you need to do. I'm just sharing with you what I have done and what a lot of folks that I know of have decided to do for themselves. So the other reason that I believe in bonds in this very particular moment in time, more so than I do in equities, is because I believe that we are entering recession, that we have entered recession, let me be correct, even though they can't call it. Based off of what I'm seeing, that's what I believe that is happening right now. I could be wrong, but I seriously do believe that. So that's sort of the premise under which I'm operating. My biggest concern is that we're not just entering a recession, that we are potentially hitting a depression, and here is the reason why. We have a large number of population around the world that is aging, and they're aging fast. And vast majority of those folks are retiring as CEOs, as executives, as just business owners. I mean, they are slowly but surely, especially as I look into the near future of next like 5 to 10 years, they're all going to end up being in retirement. They're all going to be stepping out. When folks get into the retirement, they no longer are looking to buy new things. They don't need it. Their couch is just perfectly fine. It finally has this nice little place where you can sit, and I'm sure that you can relate to that as well. You have your favorite chair or favorite couch where you can relax and read the news or watch the TV or whatever you end up doing on your free time. So they're not very big spenders. Yes, they might go into things like cruises and resorts and that kind of stuff, but what we have seen is some stuff with COVID and some of the stuff with the pandemic is that they're not doing that at all. So that's also stopping all of the economic stuff from happening. People are not going out, people are not buying things, everybody's sort of hunkering down, and that's causing the economy to come to a screeching halt. That, combined with the aging population, combined with sort of this large debt, lack of liquidity, leads me to believe that more and more money will be printed. That also means that our currency will be devalued, and that also means that some assets will likely keep going higher as we keep going through. Now, in a shorter period of time, we might experience, as we have already experienced with the paper asset markets, the prices will actually drop and go down. We also might see that stuff happening with cryptocurrencies, with real estate, with oil, with all kinds of stuff. So you literally could be looking down at everything going down, because as some people have been saying, it has been everything bubble for the last 10 years, a little bit longer than that, because people have been talking about that however bad the 2008 was, it should have been even worse. It should have shaken off even more things, but because of the financial and monetary stimulus, we were not allowed to kind of hit that bottom that we needed to hit in order to have the healthy economic uprise. So now I think folks are trying to sort of delay that stuff. How far can the market go? It's anybody's guess. We could have seen the worst of it, although I personally doubt it. I think this is just the beginning. But some people have been calling for roughly about 50% drop. There have been people calling for as much as 80 to 90% drop. 50% drop will mean for the Dow to be right around 15,000, 14 something, 15,000. If we're looking for a drop of 80 to 90,000, we are looking at Dow at being in single digits. And I know that that sounds incredibly scary, but that's kind of what folks are talking about. Where exactly it's going to land, I really don't know. A lot of people have been sort of saying, okay, if I can exit then the paper assets, where else could I go? Some of the things that we do know about depressions and recessions is that bonds typically tend to do well, at least short term, maybe not long term, but at least short term, so something to consider. Cash seems to be doing really well, although when they start printing it, that money will buy less and less of it. However, even though we have been printing a lot of money, I think we're having strong deflationary forces coming our way just for the reasons that I have explained earlier. And what makes me believe that is that with all of this stimulus and all of this printing and all of this debt that has been accumulating, our inflation, while it is, I mean, we live in an inflation society, and so while it has been relatively speaking high, it hasn't been nearly as high as one would think would be with all of this money printing. I think what is going to happen is when I hit this deflation, they're going to push all of the money possible. Some sort of event is going to happen. I don't know what that event is. Just like about a year ago, maybe 18 months ago, plus minus, I was talking to my sister and I was saying, I have this very strong belief that there's going to be a market crash. Some sort of event is going to happen. I'm not quite sure what, that is going to ding it down. It might come naturally, but I doubt it. I did not think that it's going to be the virus and the pandemic that is going to cause it, but here we are today. I'm not saying that COVID-19 is the cause for it. There's many more issues, fundamental issues in our financial markets that are happening in our financial society as a whole that are happening, that is the problem. And so, with all of that stuff they have done, it barely has moved it. Some of the stuff, yes, has gone up in prices, and price is really basically an end result of what happens because of inflation. It just means that your money buys less, but we see it as prices going up. We've seen a huge uptick in the assets because vast majority of the money that has been given and doled out has been given out to the people that probably need money the least, and they just ended up piling it into the assets. So that's where we have seen some of that stuff. But I think a lot of the stuff is slowing down and stopping, and our inflation hasn't been that high. Even if you follow the shadowstats.com, which I think is a much more accurate prediction of where we are with the inflation. So I think we're going to hit sort of a more of a deflationary period. Some sort of event again is going to happen, and that's when we're going to potentially shoot up into much higher inflation. And it might be hyperinflation, I don't know. But when I say higher inflation, I'm talking it's going to be in double digits, maybe higher than that. So that's kind of where I'm thinking right now of what things might happen. In the instance of the deflation, bonds and cash are going to serve you incredibly well. So start thinking about those components. In the hyperinflation and the high inflation, money and bonds don't do well at all. What does well are going to be assets that you have leveraged through debt. And if you decide to play that game as well, make sure you have some reserves set aside and make sure that those are true assets, meaning they pay you over time and that debt is a fixed term, fixed rate, so it doesn't reset as we start resetting back on up. So we're kind of coming down the slope. If you were sort of, I'm a visual person, so if you kind of imagine, we're sort of humming down the slope and we're going to hit sort of the bottom and it's going to be a sharp bounce up. That's what I believe. Again, I could be wrong, but that's sort of the premise under which I am working. So what are the good things to potentially invest in and buy? That is what's on everybody's mind, so that's why we put it over here in the investing component. So let's talk about that. And for that, you're going to have to tune in the next episode, and I promise I will talk about it. Until next time, stay forever money blessed, and do remember, you are only one deal away.
I want you to be happy. Don't you want to be happy? I want to be happy.